heard him speak that. So I mean, there were like Rod's session was amazing on mindset. So Cornelius, you've put an amazing event here together. So first of all, a round of applause for Cornelius.
Thank you, thank you, thank you.
So today I want to talk about something different. When Cornelius, came to me, I'm like, I don't want to talk multifamily. I don't want to talk apartments. People get, I mean, I'm sure I've had enough of it over the last 2.5 days. So I do something different besides apartment investing. And I got started in this about a year and a half ago, primarily for myself, because I read this very inspiring book called Money, Wealth, and Life Insurance: How the Wealthy Supercharge or Turbocharge Their Savings. So, if you haven't read that book, it's an absolute must read to understand, or at least and today, I hope you'll understand and walk away understanding the strategy. But if you haven't read that book, I still highly recommend that book because it really gives you a big picture of what the strategy is about. And we're not talking here about going and setting up your own bank, but leveraging something which has been around for hundreds of years, literally since 1847 or 1800s, early 1800s. Leveraging something which has been around since 1800s has proven itself over and over again, and then using it to act like your bank. And that's what we're going to talk about here today. Just a quick show of hands. I think there is a raise hand here or something in this controls. Is there a raise hand? I don't see it here, but how many of you have heard about infinite banking? Just, I
I
don't know.
have.
Okay. A couple of you, I assume. So before we get there, I'm going to ask you today, what you're going to learn about is creating a high yield, safe bank account in quotes. It's not really a bank account, but it acts like a bank account that you can use for investment, college savings, retirement, and much more. So if you're here to learn about this, then you've come to the right place. So why am I qualified to talk about this? I'm an apartment investor. So how did I get into this? A little bit about my background. I have been a real estate investor for over 10 years. I started in single family, moved to multifamily when I saw that I couldn't really scale single family business. I got tired of tenants, and I still deal with tenants and I hate it. And someday I think I'm going to get myself out of single family 100%, but it hasn't happened yet. I got into real estate full time after spending 19 years in technology. I worked for IBM and their company called Atlassian. Very hardcore developer, work with customers, different roles within these tech companies. I have a master's in computer science from Texas A&M. So I got out of it, started my 9 to 5, like a lot of people out here, and then realized, okay, this is not what I want to be doing with my life full time. And kind of veered towards real estate investing after dabbling in the stock market for a while, the options trading for a while. And then I was just tired of the volatility. And I said, how about real estate? And luckily, I started at a great time, 2008, 9. Didn't seem so great at that time. It was scary as hell, but I got started at the right time looking back. I'm also now I do syndications, mostly multifamily, but I'm also looking at senior living syndications. I am an investment focused realtor working in the Austin, Texas area, and also a life insurance broker. And honestly, over the entire COVID situation, life insurance has become a big deal. And I didn't understand, uh, initially the real estate market was literally stopped, right? Like a couple of months after COVID hit, it felt like everybody was trying to figure out, oh my God, what the hell happened? So life insurance took off. My life insurance business took off. Even though I started it before, I really was able to focus on it the last 3-4 months. So I've had now a lot of success with it. I'm working with a lot of clients on it. So I just thought, to break up the whole apartment investing secrets, we'll share some secrets of establishing your own bank account instead. Like I mentioned, I have a rental portfolio in Central Texas area, Austin and San Antonio. I own and manage it. I'm also a general partner in over 650 multifamily units and a limited partner. I have been investing since 2016 in multifamily, and I have over 2,200 units personally invested. I also run this group called Purely Passive Investor Group. If you want to find me on Facebook, and I do a lot of bi-monthly educational webinars and put all those webinars out on a YouTube channel called Cherry Street Investments. I'm a single mom. I have a 15-year-old daughter, and I have two small puppies. So that's a lot about me. So let's come to wealth building. For me, this was kind of an aha moment after I learned about infinite banking and the whole life insurance aspect of setting up my own bank. I saw this and it really, really resonated with me. Typically, we find that a lot of people, right, like when you look at the wealthy people, they are not sitting out here. They're not sitting in the tier three and tier four investments as much as they are sitting in tier one and two, because for them, wealth preservation is just as important as wealth creation. So if you look at a typical investor portfolio, and I look at a lot of those now being on the life insurance side of things, because we look at financial questionnaires and look at the holistic view of the person's finances. And I can say without a doubt that 80 to 90% of my clients have 80 to 90% of their wealth in the stock market. And if you look at it from a control standpoint and a risk standpoint, the risk is the highest and the control is the least in the stock market, right? It's all based on speculation. You don't really know which direction the market's going to go or when it's going to turn. So it's interesting that we kind of have this whole pyramid flipped upside down in middle class, whereas the wealthy are always building up their tiers one and two. And this kind of closely relates to the Maslow's needs hierarchy of needs, if you're familiar with it, where the base is that food, shelter, clothing, and all the basic needs. And then you build on top of those basic needs with actualization and all sorts of you can look up Maslow's hierarchy of needs. So this is your financial hierarchy of needs. And for me, this was like a huge aha moment, because I'm like, okay, where have I been investing? Like everybody else I meet lately, except us real estate investors, where we might have tier two and tier three investments, but we are still heavily in these two tiers, and we forget a lot of times about the tier one. And what is tier one? Tier one is your savings, your protection. Like when you talk about reserves, right? You buy a property, you have to have cash reserves. You buy a multi-family property, you have to have business reserves for that apartment complex or whatever kind of property that is. And we also forget about the protection aspect. What happens if your partner or somebody significant in your business passes away or something happens to them? Do we ever think about that, right? What happens to the main sponsor in a syndication passes away? So huge things that we completely miss out on the tier one. We always assume that things will go well. And from a personal standpoint, when you think about savings and protection, it's your emergency reserves for your family and yourself, right? To run your household. You're talking about business reserves for your apartment investments, for your direct investing, whether it's single family homes or whatever else you're investing in. And also the protection where if something happens to you, what does your family have, right? You don't, I see a lot of GoFundMe's happening with COVID and everything else, where very financially stable families are going through a huge change when the family's basic provider is going through a life crisis in terms of health or some other issue. So what we'll talk about today is setting up that solid tier one foundation, because everything else builds on top of that tier one foundation, guys. I mean, we all forget about the tier one and we are just gung-ho. And I mean, to be honest, I was completely in the tier twos and threes and some in tier four. I had literally, except for a savings account, which earned me 0.75%, I had nothing in tier one. So for me, this was like a huge moment. And you want this pyramid to have a strong base, right? We don't want the base to be just lean and then you start building this tower on top of it. And the wealthy, and we need to take some lessons from the wealthy when we build this pyramid. So what is all the tiers about? Like I talked about, when you directly invest, there are two kinds of direct investing. Like you could go buy a house, you could buy something that you have a lot of control over. But the best and the most necessary direct investing is an investment in yourself. You are your biggest asset. And how have you invested in yourself, and how have you protected yourself? That's important to think about. And then when you come to indirect investing, maybe you're investing in a syndication, maybe you're investing in a mobile home park. There could be a whole range of investments out there. And I do this with my investors all the time, right? Like I'm helping them with the indirect investing as a syndicator, but I'm also helping them make sure that they have this tier one where their savings are deployed effectively in an account that they can borrow from at whenever they need it. So the tier four is the speculation. Like a lot of you guys probably are not in the stock market, or maybe you have some portion of your assets in the stock market. But if you're talking to investors who are investing in your apartment deals or your indirect investment deals, you'll find that a lot of them are sitting in tier four. And this is when we need to kind of double down and say, okay, how can we establish that base better? And that base is partly, let's say you have a savings account, but you also have a high cash value whole life policy. And life insurance has been maligned and massacred by life insurance agents for time immemorial, it seems, because I think what happened somewhere along the way is that agents got greedy in the way they designed these policies. And somehow it became like car salesmen, right? Like you think about life insurance, you're like, I don't need it. But when you look at high cash value whole life policies that are designed well, they actually work really, really well. And today what we're going to talk about is how can we utilize these high cash value policies to actually set up your own banking system that you can borrow against, that you can use for anything. And when I mean borrow against, it's really not a borrow, because it's your own money that you're taking out, just like you would take it out from your savings account. And also, if you have any questions, feel free to type it in the chat box. I'll get to it, or you can ask me as we go along. That's fine too. So again, a different look at the hierarchy of wealth is, we talked about the bottom portion where you have your insurance, you have your high cash value. We call it a wealth maximization account because of the way we treat the account. It's not just simple death benefit insurance. We have investment real estate here. You might have your business here, which you have 100% control over. You have maybe oil and gas investments, syndicated real estate, private lending, and so on and so forth, which are, again, indirect investments because you don't have control over them. And finally, up here in tier four, you have the stocks. So any questions so far, folks? Okay. So let's say we are looking at, in our lifetime, we set up different investments and we create different buckets of money. And what I mean buckets is you have the pre-tax dollars. I call it the Congress's playground, and I'll explain why shortly. We have post-tax dollars. Of course, in a growth is taxed. You put it in your stock market or whatever. You pay taxes and then go invest it somewhere, whether it's stock market, whether it's multifamily, whatever, but the growth is taxed. And then you have your tax-free dollars, which is your life insurance. So the growth in life insurance is tax-free. And let's look at what that $80,000, when you take it out of these accounts, will be. So in your pre-tax dollars, you're always banking on the fact that when you put the money into the policy, or into the account, let's say it's a 401k account or IRA account, you're not paying taxes at the moment. You're assuming that your tax bracket currently is really high. And your assumption is that when you retire, your tax bracket is going to be lower somehow. And I always ask people, do they want to retire poorer? Do they want to earn less money when they're retired? Do they want to not live the lifestyle they're living today when they're retired? And answer almost always say, no, I still want to make some money. I still want to live a very comfortable life, but I'm assuming that it'll be less dollars. And I think that is a very faulty assumption because one, your tax rate is not at your control. The Congress decides what your tax rate is 20 years from now or whenever you're going to withdraw those dollars. You're always assuming that you're going to be in the lower tax bracket, which might be completely wrong because the Congress can decide at any time those tax brackets can change. And they have. If you look at the last 30 years, the tax brackets have changed. And so you have absolutely zero control over this. So let's say you have $80,000 at a 35% bracket, you actually have only $52,000 to spend. In the growth, when the growth is taxed, your growth is taxed, but everything's taxed. I mean, after that, it's free of taxes. So you withdraw the growth and the principal. And let's say you have about, I mean, this makes some assumptions about the growth rate of the money and all that, but let's say you have about $66,000 or $70,000 to spend. With life insurance, because of the way it behaves, you actually pay no taxes when you withdraw. Actually, it's not a withdrawal. The way we structure it is like a loan. And I'll talk about it a little bit more. And the withdrawal is also tax-free up to the cost basis in life insurance. So essentially, this gives you a way to save money into a place that allows you to take money out to live later in life for your retirement without paying taxes. So the question is, what bucket do you want to fill? And a lot of people I've seen fill that pre-tax bucket a lot. And sometimes it makes sense. If your employer is matching those pre-tax bucket in a 401k, it makes sense. You have a Roth, you can maximize that, but unfortunately, that's not a whole lot. It's $6,000, right? So a year right now. So the question is, how are you distributing your money across these three buckets, and which bucket do you want to fill and how much? So let's look at some financial characteristics of the different kinds of accounts. So we look at a savings account. It is definitely safe. It's very liquid. The rate of return is pathetic. I mean, what are we looking at right now? I think the highest I've seen is 1.25 or 1.5, and that's about it. And that is after tax. So like I mean, you still have to pay taxes on whatever that 1.5 is. And when you're done paying taxes on it, it's way below that. So it's post-tax, it's pre-tax dollars, right? Like you have to pay taxes. Now you're looking at a qualified account. You don't know about the safety, especially if you're going to invest that in mutual funds and stock market. I mean, I know personally, my 401k was 50% of what it was before 2008. I lost 50% of my 401k in 2008, and I just stuck in there. And some people I know even sold it at that 50% loss, but I stuck in there for 5 years to recover just what I had before. So we spend a lot of time losing and gaining back the same dollar in a qualified account where you are investing in the stock market. And is it liquid? Not quite. Some of the mutual funds have guardrails around how often you can sell them. Obviously, you can't pull out of your 401k very easily without penalties, except right now where there's CARES Act, and you are able to pull out some capital from your qualified account, but you still have the taxation, you still have to deal with all those issues. The rate of return can be great over a period of time, a long period of time, provided you don't go in and muck with it and try to pull it out when it drops. So it can be pretty substantial. Is it taxed? Yes, it is taxed, right? And there's also another thing in 401k a lot of people miss out on is where there's actually fees for all these mutual funds and everything you're investing, there is fees involved. So you're not looking at the return holistically. When you look at it, you're not looking at the taxes and, I mean, it's not taxed initially, but when you pull it out, it is taxed. So the thumbs up is because it's not taxed while it's growing because it's a 401k. So you have a home equity line of credit. It's not really safe. You could take it out, yes, but the rate of return, not super great. Is it taxed? How is it taxed? It's not really taxed. You don't really pay anything when you take a home equity line of credit, right? It's just a line of credit. Similarly for a bank, for a stock portfolio, not safe. Once it's invested, not safe, right? Liquid, yes, it's liquid. You can sell your stock most times. Maybe you have to lose some money, but you can still sell it. Rate of return is great. It's also taxed, right? So when you look at life insurance, it actually is the only thing which checks all. It's safe, it's liquid, it's the rate of return is very high compared to the fact that it's a tax-free growth. And we'll talk about how the tax-free growth plays into the returns, and it's not taxed. So it's tax-free. So I found this whole pipe example really interesting when I first saw it. And I wanted to kind of talk through this about, when you start investing in yourself, you have a potential, you have a wealth potential, you have a potential to create these X amount of dollars over your lifetime. And when you invest in yourself, whether you get a graduate degree or you go learn about multifamily investing, you are creating more potential by investing in yourself. And maybe you're doing a side business, whatever it is you're doing, you're creating that lifetime potential. Typically what happens is a lot of people lose a lot of money in that taxation. There's a filter. Think about it as a water flowing through a pipe, and there's a filter, and there's a huge portion going out in taxes. I talked to some of my California investors, and they're losing half their income in taxes, like 50% gone in taxes. That's huge, right? Over a lifetime, that's a lot of dollars. So, and the rest 50% or 30, maybe it's, in your case, it's 35% going in taxes, and the rest is going to supporting your lifestyle. And, as multifamily investors, all of you guys know how to play with some of this, but if you're in a W-2 job, you're still affected by this huge tax filter coming in. And none of us, I'm not an advocate of cutting back and saving more. I love to save, but I also love to enjoy my life. I don't look at cutting back this standard of living or my lifestyle just to save money, right? I did that when I was a college student, lived very, hand to mouth kind of thing. But right now, I want to live my life. I want to travel the world. I want to do all the things I want to do, but I don't want to compromise on saving either. So the only way you can do that is you either have to create your lifetime, increase your lifetime earning potential by maybe you're doing a second job or whatever it is, like a side business or a side hustle, or you also, along with that, increase or decrease the amount of taxes that you're paying so that you can funnel more of this into your safe tank and a risk tank. And the way I look at these safe tanks and risk tank are, when you talk about savings, you typically think about a savings account, right? You're putting your emergency reserves in a savings account. And that savings account has a lid on it, which means you can never lose your principal, right? There's always that principal preservation aspect. Whereas your risk tank has no lid on it, which means you can always lose the principal, whether it's apartment investment or single family. There's always a chance that you can lose your investment. Some are riskier than others. Like if you're in the market, it's riskier than others. But regardless of it, it's always a risk reward ratio involved in the investment tank. So when you think about savings tank, you typically think about just a savings account. And this is where we think about insurance as that savings tank. Instead of insurance as a death benefit insurance, like to something to safeguard your safeguard your family if something happens to you, we think about insurance as a savings tank. So what we do is that we can put our opportunity dollars, our property and business reserves, our emergency savings in this business tank, in the savings tank, and borrow against it when we need it. And the way it works is, let's say I'm going to go buy a rental house here. I take a bank loan for, let's say 75-25, 75 LTV. Now the bank loan 75 LTV would normally come from a lender. And then what I do normally with a savings account, let's say I have my savings account, I empty a certain portion and put it as a down payment here. So I've saved this 25% down and I move it and buy a rental house. That's one way of doing it, right? What we do instead is that instead of emptying this tank over here, is that we actually keep that tank full. meaning that imagine all these collateral, all these opportunity dollars, the reserves, and the emergency savings are sitting in a life insurance policy. What the insurance company does is they use that as a collateral, and that collateral is still sitting there, that those dollars are still sitting in your policy, earning money for you while you take a loan from your life insurance company. And that loan goes to fund your investment as a down payment. Any questions? I'm going to pause there and see if there are any questions. All right, I think there's something here. Will you
Hi, this is
discuss? Yes.
this is
Nancy, sorry, go
I'm
ahead.
sorry, didn't mean to interrupt you. You said if you have any question, I have a question for you.
Sure.
I understand what you're saying, the collateral versus going into your insurance and getting the loan against it. So what are the servicing charges for the loan when you're creating a loan against your collateral?
So usually your account is making between 5 and 6%, depends on the policy, maybe it's 5 and 7. And your loan is usually, I mean, it depends on the company, but like, for example, the one I'm using a lot nowadays is around a 5. So, but the way I'll go into how this would work as well when you're taking a loan and what your amortization looks like on the loan versus when you pay it off, what that dollar interest looks like. Nancy asked another question. Will you discuss the safety of insurance companies through the different crises? How safe are insurance companies? Nancy, I'm going to address that and actually have a slide just for that. And please ask me the question again if that slide doesn't answer it. Venki, I'm going to cover the interest part as well in a couple of slides later.
Thank you.
No problem. So a lot of folks have heard about Dave Ramsey, and Dave Ramsey always talks about the power of compounding in the negative way. Because he says that the kind of debt, I mean, debt can kill you because it can compound negatively against, not in your favor, right? You take credit card debt, it can compound. And I call that like a basic financial education 101. But the way I look at it is normally we save for something, we save, pay cash for something. Let's say I buy a car. We save, go buy a house. We save, and we keep doing this over and over again. And we are not, in this case, exploiting the power of compounding. Right? We are paying maybe compounding, we're paying down compounding debt with like a mortgage or something, but we are at least not, most of us, I hope, don't have credit card debt, which is piling up and negatively compounding against you. And you're basically just keeping up with the interest payment on it or the minimum charges on it. So what we do in life insurance is we actually use the compounding effect in your favor to keep increasing that compounding effect within the policy instead of pulling cash out. So if you look at this figure here, it's like save, and then you completely deplete your bank account and you start over again. Whereas here you save, and you never deplete your life insurance account because remember, the money never leaves the account. So when you do something like that and you keep contributing to the policy, your growth in the policy compounds. And a different way of looking at it is this. And I had another aha moment when I saw this, and I realized what I had been doing all my life and what the difference between interrupted compounding and uninterrupted compounding is. So typically you're saving in a bank account, and that's your red line, this red bars, and you're saving in an account, you save, and then you go deplete the entire savings because you're going to go do a big purchase. Or maybe you have emergency reserves. That aside, let's say you're saving to buy a house, you save and then you deplete it. And then you start all over again. So you're compounding really, if you look at the red, it never really takes off compounding because you're depleting it each time. So if you look at the lifetime, you look at it and go like, why don't I have any compounding in my account? Is because we interrupted that compounding each time we took away from it. So in life insurance policies, there's uninterrupted compounding because your own dollar never comes out of the account. Sorry, I kind of mess up here. Your own dollar never comes out of the account. So this just shows $1,000 investment over a lifetime of 30 years and what it could become when there is uninterrupted compounding. So this is to answer Venki's question about how we pay off. I mean, I'm showing a 6% rate here, but it's usually around 5. And the policies that I'm doing right now are mostly around 5. And the company has been around 5 for a very long time, like between 5 and 5.25. But what's interesting is that when you look at these two, the first time I saw this, I was kind of scratching my head and I'm like, okay, this doesn't make any sense to me. What am I missing here? So I borrowed $50,000 from a policy and I'm paying 6% interest, although I'd be paying lower right now. And the time over a time period of 25 years. Let's say I put this money into my life insurance policy and I borrowed against it. Now, over the lifetime of the loan, this is the interest I would pay. And finally, I'd have no loan against my policy. But also notice, this is the key factor here. Let's say my property was cash flowing and I took that cash and put it away towards that loan every month. I'm basically paying down the loan just like you would pay down a 30-year mortgage, right? So an amortizing interest loan, and you're basically paying down the mortgage. So your interest paid is $46,000. Now, on the flip side, look at what your policy is doing, right? You just put $50,000, no more deposits, and you let it compound at 6% uninterrupted. Uninterrupted being the key word, right? You never pulled that cash out for anything. Then over a time period of 25 years at the same 6% interest, you would have earned $164K interest. So that is really this for me summarizes what we're trying to do here, is that you sock away money in your life insurance as if it was a savings account, because you never pull it out, except as a loan. You take the loan and then go do whatever investment you want to do with it, and then pay that loan back over a period of time, and you end up coming out much further ahead. Plus, this account that you're sitting with here is safe and it's liquid. You can keep borrowing against it as long as you have the collateral. So let's say I have $200,000 in my life insurance cash value. I can keep borrowing against it and returning it back. As long as I have the collateral there in the account, the life insurance company will loan it to you within, like they'll cut you a ACH transfer in 3 days. So in that sense, it's very liquid.
So one more question, sorry, Kavitha.
Sure.
Regarding the interest 6%, are you paying that back to you? It goes back to you, or is the insurance company takes that?
So
I'm sorry, go ahead.
No. Finish your question, please.
Because see, if you are taking the loan against your 401k or your EQRP, so whatever the interest is going back to you because you're paying yourself back, the principal and the interest. So how does that work, those logistics over here?
So it's actually going to the insurance company, because if you look in this, I talked about this. See, your insurance company is making the loan to you. So they're going to get paid for the interest. But your policy is still earning much more than that because of the uninterrupted compounding. So effectively, you're still making money. While your money is working for you in your investment, you're still making money within the policy, because even if the loan dollars, like let's say you pay back the insurance company over 25 years, you don't have to. And that's the beauty of it. Like if you don't want to pay for 2 months, you don't have to. You don't have to pay ever to the insurance company, but you want to pay, because otherwise your loan accumulates at the same rate that your your interest accumulates at the same rate that your policy is compounding, and you don't want that. What you want to do ideally is to pay back the insurance company and still let your policy accumulate uninterrupted. So effectively, even though it looks like 6%, your policy is actually making much more, like we saw here. Your policy interest earned is much more because you are actually letting it grow uninterrupted. Whereas here, you're paying it down, right? So you're paying the insurance company this 322. You're not paying yourself. Very different. But,
yeah, but isn't that like a double debt for the insurance companies then, because you're giving them your dollars to use it, right? They're making money off of your dollars. On top, they're taking the interest on your dollars too. It's kind of double dip for them. How would you
It's not because they're paying you money every year, every month. So let's say insurance companies guarantee like a 4% guaranteed rate on the money that's sitting in your account. Plus the companies that we work with, they pay dividends where you are a part of the insurance company, like you're a stockholder. It's called a mutual company where you're all a part of the company. So they distribute all their profits to the shareholders. So you're collecting two ways from them as well. So your account is growing as well. Like I said, the 6% interest is the insurance company giving you money.
Thank you.
Does that make sense?
Yes, it does. Thank you.
Okay, no problem. So I'm sure a lot of you guys have read about Rich Dad Poor Dad and been exposed to Robert Kiyosaki. So Robert Kiyosaki talks about doodads. Doodads are your expenses. Maybe it's a nice car or your college, or you want to go on a nice vacation. Definitely you can use this kind of account for all of those, right? You can take loans out whenever you need it. I mean, it's basically your money, but it's sitting in an insurance with an insurance company, right? The cash value of the account. And then you want to pay it back, right? You don't want to keep depleting the account, but you want to pay it back just like you would make a car payment, just like you would pay back your college account, college loans, just like you would, you know, take a loan for maybe a vacation, which I would never do, but you pay it back. So what I would really use this account for is investing, right? Whether you're buying a house, whether you're investing in multifamily, whether you're doing any other kind of investment which is generating cash flow for you, and then use that cash flow to pay back the loans against the policy. So in effect, I mean, a lot of people have this hang up that they are taking a loan, but it's your money, right? Your money is still held as a collateral for this loan, and you're paying the insurance company, yes, but your policy is still earning a lot of money in there, which is way more than the interest you'll be paying if you keep paying back the account. And I think that's really the big catch here, is that you want to take the cash flow and put it back towards the loan and pay down the loan much faster than the account is growing, and let your account grow. So any questions so far? I'll take a little pause here. I know I've been like going through a lot of stuff. Does this make sense? Oops. All right.
Hi. Yes.
Sure.
Sandra?
Hi,
Okay.
Sandra.
So I did exactly that, and I didn't even know that's what I was doing. I mean, I wasn't like doing that out of like a real strategy, but it just kind of came out like that. So I have, and so here's my question also. I have a policy that, and you didn't talk about the death benefit, because I have a policy that also has a death benefit. You know, and then there's the, you know, that reserve money in there. And so I put it in there just because I got a lump sum of money from an investment. So I put it over there for safekeepings in this insurance policy, you know, with the death benefit and all. And then a deal came up then. So I was like, oh my gosh, I need some money. Where I'm gonna get this money from? And I was like, oh, I got this insurance policy. So I called them and they said, oh, you know, yeah, you can borrow the money, you know, and it's at, I'm looking at it, it's at 2.75% is the interest rate on the loan. And, you know, they sent me the check like in 3 days, like you said, and everything like that. And I was like, and it was like, you're still got this money that's earning, you know, you still have your money that's earning interest, even though you now have a loan against it, which I thought was like really cool. And this was just me doing, you know, just because this is just a necessity kind of thing. And but so now here I am right at this point, and you're like so very convenient at this point that you come on here, because I took the money, did the investment, you know, closed on the investment. Now I just recently did this, and now the money is just sitting in my checking account. And I'm wondering, okay, is this the best place for me to, you know, go back and put back the money? Absolutely. Or should I, you know, do something else better with it? And so today you're actually kind of answering that it's probably the best thing for me to go ahead and put it back, because it was very convenient. It really was. And, you know, I always still had that death benefit or something. I'm 61, so, you know, I got to kind of be concerned about that. So, you know, it's something was to happen, then there's, sort of a nice size of death insurance policy attached to it. So, but I was then thinking, well,
Is there a question? Sorry to interrupt you,
Okay.
but can you get to
Go
your
ahead.
question? Because we have only 15 minutes.
Okay, so I think it's a statement. So I think the thing is for me to put the money back in that insurance policy because it's earning 4%. Which is not a lot.
Four
And
is
that was
not a
my
lot.
thing.
Actually, I don't know what kind of policy you have. We can look at it, but it's usually much more than four. Four is just the guaranteed portion. There's usually a non-guaranteed portion, and
Yeah, there we
that
go.
makes it much larger. So, and again, I'll talk about, yeah. And also, just to point out to everyone, the death benefit I don't talk about, but it's always there. When you buy insurance, there's death benefit. That's the primary reason. But we flip the policy to make the death benefit the secondary reason. And we focus on designing the policy differently. So it's focused on the cash value and not the death benefit. But the death benefit always comes with an insurance policy. That's unsaid, right? It goes without saying. So I kind of want to go through, I have a lot of material here, so I want to run through this really quick. So I'm just going to show you a little, could you, everyone please go on mute? Thank you. Someone is typing really hard. Could you please go on mute? Thank you.
Oh, I can mute it for you.
Okay, awesome. All right. So I want to talk about these assumptions. We just take an assumption, a male, 40 years old, contributing 20K a year for, I believe it was, is it 24 years actually, the contribution, this one was, it says 30 years, but I found when I was doing it was 24. But anyway, the min and max is flexibility where, let's say I want to contribute 20K a year, but I'm not really sure that I can contribute 20K every year, right? And think about the contribution as savings, right? Don't think about the contribution as a cost of insurance because it's not. The way we design it, the cost of insurance is really, really low and the cash value is really, really high. And that's why it's a high cash value policy. So let's say I want to contribute 20K, but I can't do it every year. Let's say I have a lean year. I can contribute the minimum for it, which is your base portion. We call it the actual base portion or base premium. And then I can contribute up to 20K depending on how the policy is designed. And that's really the min max here. I'm assuming a 35% combined tax rate for these numbers here. You'll see in the next few slides. And insurance returns are typically around 4% guaranteed. And then you have another 2.37 dividends on the cash value. Now, remember that these are tax-free, right? That's the big thing to take away. It's that all the growth in an insurance policy, which is designed well, is tax-free. So if you look at this typical policy, you can look at the cash value. Like the first year, I put in the $20,000. I have only $13,000 available, right? But the second year, I put another $20,000. I have $27,000 available, right? This is the cumulative cash value, and this is the increase. So if you look at 20,000, you got 14,000 the next year. You put 20,000. You got 20,000 the third year. So what we're trying to do here is we're trying to optimize this so that every dollar you put into the cash, into the insurance is immediately available to you as cash value. So that's really the gist of what we're trying to do here. And if you notice here, you put in 20,000, you're actually increasing it by 22,000. So how's that? There's dividends happening. There's growth happening in the account. There's guaranteed interest coming from the insurance company. So why is it low in the first few years? It's a question I get very often. It's because the insurance company is trying to recover the cost of setting up the policy for you. And they're going to invest your dollars into other investments that they have, which is safe investments usually because they're very high quality investments which are collateralized investments. So you don't run the risk of losing your dollar in those kinds of investments. So essentially, if you look at the cash value, the first couple of years, the insurance company is trying to pay off the commissions, all of the overhead. But over a period of time is when you start looking at, we call it a seasoning of a policy, where every dollar you put in actually comes out as more dollars as the policy grows. So let's look in year 15, you put in 20,000, it's actually a $43,000 increase in your in your insurance policy. So this is the compounding effect that I'm talking about of the policy, where it's kind of feeding into itself and growing. So typically when you look at, let's say a 30-year net at your taxes, it's not taxable, right? We're looking at age 64. So your 30-year net is $1.3 million. If you contribute 20,000 a year since age 40 through actually, you're contributing age 40 through age 64, which is 24 years. And then you're looking at a 30-year period and you're looking at the net value there. Right? So it works out to 5.37 IRR. It doesn't look like a big IRR. We are used to 15 IRRs, but remember, this is tax-free, right? So if you were to take the same calculations and put it in your savings account with assuming you're in a bracket of 35%, you would need to earn 8.26% in your savings account every single year to match the same as that insurance policy that you just saw before. So if you wanted to make 1.3 million at the end of 30 years, that's what you need to make every single year. And we are making like 0.75 or 1.5 in your savings account right now. We look at an investment, a managed investment. Let's say you have a stock investment, right? Or a mutual fund. So let's assume, we're assuming a very nominal management fee, and we are looking at a 30-year net. And the rate that you need to make every single year in the stock market to make that 1.3 million would be 10%, over 10%. So I think the lens that you have to really look at it as is a tax-free lens, because we never take into account taxes. We never look at taxes. And when you start doing that, and how many years, I mean, can you realistically make 10% in the stock market every single year? Probably not. So this is where having that tier one investment, which is solid and still making you good returns. So you could think of it as 10% returns in the market if you're making a 5.35 IRR in the insurance policy. And plus that money is liquid and available for you. So we saw here, this is just a summary. So if I were, looking at insurance versus savings versus managed investment, this is kind of like the rate of return that each one needed to make. Like if the insurance policy makes 5.37, your savings account would need to make 8.26 to have the same net return. And your managed investment would make 10% every single year to match the same return. So this was a question which came up about insurance safety, and I wanted to address it because it comes up very often. How safe is it compared to a savings account? So I don't know how familiar folks are with FDIC insurance, which is what your insurance is for your savings account. FDIC is actually very, very low on reserves. Right now, probably even lower than ever. And they just think that they might have to just print money if they ever get to a point that banks start to fail. Right? So they are running at 7% reserves, which means for every $100, they only have $7 that they actually pay out if something goes wrong. So in comparison, life insurance actually is a contract between you and your insurance company. And most of these insurance companies have been around since early 1800s, and they have paid these premiums, these guaranteed returns and dividends through Great Depression. I mean, for me, that was like, oh my God, really? How you think about Great Depression, people were massacred in Great Depression, businesses were gone, but life insurance company actually still paid out. And what's interesting also, if you look at corporates, you look at big companies, they always carry a lot of life insurance policy. So just to give you an idea, the Bank of America actually carries $21 billion in bank-owned life insurance policies. So if you look at the corporates, you look at the wealthy people, their money is huge in life insurance. Their life insurance portion of their dollars, like if their total net worth is basically huge in life insurance, and then they borrow against it to do all these other investments that they want to make. So it's kind of like contradictory that we don't use it as much and the wealthiest people use it. And for me, that was another aha moment, which I got when I read the book, Money, Wealth, and Life Insurance. And also don't forget that, there's another aspect to it where you're creating generational wealth here, because the death benefit needless to say, it's always there in a life insurance policy, is money that goes tax-free to your heirs, and that's another advantage. Also, when it comes to assets, like banks can be over leveraged. And if you are familiar with a fractional reserve banking system, banks can actually lend the same dollars to 4 or 5 different people or 8 different people. And they can be very over leveraged with their dollars, like with the fractional reserve banking system. So insurance companies actually are not allowed to do that. So they are actually leveraged a dollar to dollar. So they have enough reserves to cover their claim in cash. And if an insurance company goes out of business, every state has its own guarantee fund that every insurance company has to put dollars into the guarantee fund for every policy every year. And though that guarantee fund actually backs it up in case of, okay, an insurance company goes out of business. I mean, Penn Mutual has been around since 1847. How likely is it to go out of business? I'd say not very. And also, if they go, some companies have gone out of business in the past. And if they are, they're usually bought by another company. And you don't actually just lose your dollars just like that. And there's also this concept of reinsurance, which covers any unexpected costs that the insurance company has to face. So they are protected, and your dollar is protected in multiple ways in an insurance policy. So you can really sleep well at night knowing that it's safe. It's not just disappearing or evaporating in a life insurance policy. I hope that answers the safety question that Nancy brought up. Another question which comes up very often is the cost of insurance policy. A lot of people say, hey, do I have to pay commissions? Do I have to pay fees? And interestingly, you don't. Yes, initially the fees seem high. Your cash value isn't there in the first couple of years. That's because the insurance company is trying to pay all these fees initially, and it's all upfront in insurance policies, the fees. Over the lifetime, they depend on using your cash to go invest and making cash, and then keeping some of the cash for their expenses and their salaries and all of that stuff. And they're not taking the dollar from you. They're investing your dollar and earning from the dollar and then giving some of it back to you. So if you look at a lifetime of an insurance, of a policy, your charges are less than 1% of the total accumulated cash value, which doesn't almost happen in any investment, whether it's multifamily, whether it's a managed investment in the market, whatever you take, nobody's charging you less than 1% of your cash as a fee. So this is where, you know, you want to have a policy which lasts forever until you pass away, and you can pass that policy on to your kids. So there is a huge key, there are keys to infinite banking. Not every policy is the same. If you just go to a life insurance provider and they design your policy, I will guarantee you that your cash value will not be high until probably year 12, right? They are not designing the policy for increasing the cash value. They're designing the policy for death benefit. And that's the problem with these insurance companies, is that when you look at insurance companies, you go like, I don't really want so much money going towards the cost of insurance. I want to create cash value. And that's what we do. We minimize the expenses and the charges which come with insurance. We allow you to contribute as much as cash as possible, because remember, it's not an expense when you're contributing towards the cash value. It's your money going from a savings to a life insurance policy and sitting as cash value. You also have unlimited access, so it's liquid and flexible. And last but not least, you have the uninterrupted compounding while you take the money out and go invest it in whatever investment you have. And those are the huge keys, like the liquidity, the flexibility, the uninterrupted compounding, minimizing the expenses and charges of life insurance, and also pushing as much cash as you can every year reasonably into a policy. So what's the difference between a regular life insurance policy and a maximized whole life insurance policy, or what we call a high cash value policy? This really sums it up. Normally you'd have this huge chunk of base policy, which is almost 100% premium, a lot of it going towards the insurance dollars. And it's maximized, it's optimized for death benefit. And a secondary value is, over a period of 15 years, you might have some cash in it. but we don't want to do that. What we do is we make this portion as small as possible. It might be even smaller than 20% of that policy. And then we make what we call these paid up additions portion, which is liquid and flexible, as large as possible. And we design these policies to do this so we can maximize and focus on the cash value and not on the death benefit, although there is always the death benefit, but it's secondary for us. So we are able to increase this paid up addition portion so it goes directly as cash into your account. I think there are a bunch of questions and I'm going to get to it. I have a couple of slides and I'm trying to be mindful of time here. So what's the catch? There is a catch. There always is a catch. So you can't do this if you're not very healthy, obviously, because this is life insurance at the bottom, you know, when you all look at it. But when you are healthy and you're younger, this policy works really, really well. The younger you are, the healthier you are. If you're a woman, it works better than you're a man. If you're the same age, let's say a 40-year-old male, 40-year-old female, the female's policy will perform better because they just assume women live longer, which is a fair assumption. So being healthy is a huge factor here. As the healthier you are, your policy is going to perform much better in terms of returns because the life insurance, the cost of insurance goes down drastically. You must put in the money before you can borrow against its value. So you want to allow it time to season and grow the policy, right? And then you also IRS decided in 86 to start creating taxable life insurance policies. We call that a modified endowment contract, or you'd hear the term MEC, M-E-C. To avoid that, we have to design a policy a certain way to avoid mecking out the policy, as we call it. We don't want the policy to become taxable because IRS discovered that a lot of people were pushing in these wealthy people were pushing in loads of cash into the insurance policies and basically not paying taxes for that growth in the policy forever. So they started creating what we call a modified endowment contract, which means for a certain death benefit, there's only a certain amount of dollars you can push in over the lifetime of a policy. So we play around with that and we maximize it so you can actually push in the most amount of dollars possible. And if the proper structure is in there, you can borrow on day one, right? Like I can write a policy today. In 3 days, you can take money out of your policy for an investment. So just to kind of give you a huge big picture, why high cash value policy? You have the liquidity without doing a 0.75% savings at your bank. You have your account. You can use it for anything. So if you do a 529 account, all you can use it is 529 college expenses. You do a life insurance policy, you can pay anything with it, including college. It also doesn't count on your FAFSA forms, like the financial aid forms. So it's kind of goes under the radar from a college perspective too. You can use it for real estate investments. I have mine designed for retirement, for my retirement, like where I can draw against it for my retirement. You also maximize the opportunity cost of your capital because your money is never leaving the account. So your same dollar can do 2 different jobs, right? When you borrow against it. You're creating generational wealth because you have death benefits that you pass to your heirs. You're allowing for tax uninterrupted compounding of your money. You are earning guaranteed returns plus dividends on your savings. Doesn't matter what's happening, you always have that guaranteed portion. It's coming to you 100%. You're creating a pool of money. It's asset protected, guys. This is amazing because nobody can come after your policy and the money you have inside your policy. It doesn't matter what lawsuit you get into. You don't need any asset protection. It's automatically asset protected. You're also creating a source of tax-free retirement income with structured withdrawals. You can set up your policy and say, for 25 years, I want to withdraw the money from this policy. You can fund it when you're 40, when you're 30, and then you can withdraw it tax-free when you're older. All right, that's it. If you guys are interested in a complimentary consultation, you can click on this link. It's just bit.ly/IB-consult, and always available to talk to you guys. And I'm ready for questions. And it's 2:15. Awesome. All right, let's see the questions here. The safety part, I think I addressed. Do you have a pie chart of what categories Penn invests in? Actually, you can go to Penn Mutual and look at about, And I'm happy to send you a link. It actually shows they invest a lot in corporate bonds. So for example, let's say Coke is going to set up a new plant. They invest with Coke. They basically go to Coke and say, hey, okay, we have a corporate bond here. Coke goes, sets up their new factory, and the life insurance company invests with them, get about 7 to 10% returns, and bring some of it back to you. So they're very secure, and they also invest in real estate, actually. So you can go ahead and look at Penn, and different companies invest differently, but Penn invests in corporate bonds, real estate, big portion. Is there a max contribution? What happens when you die? Do you get the death benefit plus what's in cash value? Okay, so Amy, a lot of people have this misconception that the death benefit somehow stays constant. It doesn't. So let's say you start with a $1 million death benefit. Your cash value actually adds to your death benefit. So it's already factored in. So when you actually, in 30 years, your policy might be worth a death benefit of what, 2 million, 2.8 million. So your cash value is already factored into the death benefit, and there is no death benefit plus cash value. It's just death benefit, but the death benefit grows as your cash value grows. So there is a max contribution based on how the policy is set up. So you don't want to design a policy for put $100,000 a month or year and then put in only 20, because then it won't be optimized for the dollar you're putting into. When you die, the death benefit minus any loans on the account, the loans are removed from your death benefit. So your death benefit minus any loans on the account are passed to your heirs, and it's tax-free. Are the taxes due? No, the taxes are not due when the policy ends. The policy lives as long as you live. And when you die, the policy passes to your kids tax-free. While you live, you take loans against the policy. You can take withdrawals even against the policy up to your cost basis. What's your cost basis? Let's say I put in 500,000 to my policy over a period of 10 years, 50,000 each year, or 20 years, 25,000 each year. When I die, when I am retiring, I can pull all of that $500,000 out without taxes. And after that, I still have cash value. I can go into a loan mode and keep borrowing against the policy until I need retirement dollars. And when I'm done, whatever the loan amount is, let's say I die at 85, my child gets death benefit minus the outstanding loans. Nancy asks, how much of the 20K contribution goes to fees at the beginning? So the first year you might have 13K. Usually what I see is about 75 to 77% is available. The way we design it, 77% of it is available the first year. That goes up to 82, 85, goes up to 90. By year 4 or 5, you're 100% available. Can you put the savings chart up again? I'll go back to that. Do you have PPT available? No, I won't have the PPT available, but I'm happy to, I'm sure Cornelius can share the recording. What rate do you borrow at? Right now, Penn is loaning at 5%, but it varies, and it's usually been between 5 and 5.25. Depends on the company, right? Every company has their own loan structure. So we try to get into a policy that you can get the most bang for your buck from the policy. The growth in the policy is high, and the loan rate is low. Can you roll over your 401k? It's not a rollover. You can take a loan right now, or you can take a distribution right now because of CARES Act from your 401k, and you can fund your policy with it, yes. All right, I think I've answered all the questions. Any other questions, please feel free to ask me in the chat box, and I want to be mindful of the time. I think I'm over 5 minutes. Cornelius?
You did a great job so much. Thank you so much. It was very helpful.
Thank you.
All right, ladies and gentlemen, we have one more speaker before we do the mighty networking. Is that in 10 minutes. So I give you a quick break real quick. Go do what you gotta do, refresh everything. You got Kavitha information if you want to contact her, it'd be great.
Yeah. Oh, just so you, I don't think I put my information here. It's cherrystreetinvestments.com.
Do you mind typing in text? Do you mind?
Yeah, for sure. Everyone, I'm typing in the chat box. You're welcome to contact me there. You can schedule, there's a schedule with me time button there on my website. You're welcome to do that, or you can go to the bit.ly/IB consult if you want a free 30-minute consultation. I can look over any policies you have right now. I'm happy to walk through any other questions you have. And usually my consults with my clients, they're not a one-time or a two-time. I usually go for months. I usually have meetings as I go along, obviously fewer meetings, but I become their de facto insurance and multifamily and all sorts of different things enrolled in one. So do I do captive insurance? I'm not sure what you mean by that, Eric. I primarily focus on personal and business insurance policies. So I'm happy to talk more. Any other questions for me? Please reach out to me at Cherry Street Investments, or feel free to go to this link and book a consult.
Outstanding. That was amazing.
Thank you.
Thank you again. Woo, that was some good stuff. How's everybody doing? How's everybody going so far? Good stuff?
It's very good.
Nothing beats tax-free wealth.
Hey, taxes can suck out your dollars so fast and people don't realize it. So, yeah.
I would assume, Kavitha, that you could start, you know, like with a smaller policy as you're building your wealth, whatever, and then you could just go buy another policy, I would assume.
Yes.
Right?
So what I would do for that, actually, a lot of people also ask me that question, is that I would actually design a small policy, but go buy what is called a convertible term, especially if you're getting older. You want to lock in your insurability. Because what happens is, let's say you're 30 something, you have no health issues. When you go to 40 something, maybe you have high blood pressure. I don't know, something crops up. Right. Your insurability and cost of insurance will go up, right? So you want to make sure that you lock it in. And I love convertible terms. They cost literally the same as any term policy, but you can convert any portion. So let's say I have a 1 million convertible term. I can take 250K out of it and make it a whole life policy at a later time, as long as it's within the convertible term period. And that's what I've done for myself. I'm 44 and I'm like, okay, I set up a policy, then I want to do another policy, but I don't think I want to fund it that much yet. So I've done a convertible term. So over the next 5 years, I hope to convert some of that term to another whole policy. And I know people who have like 30 policies. Like I have a real estate investor. I don't know if any of you know Raj Gupta. I always talk to him and he's got $25 million in death benefit and he uses these policies for investing. And Raj is one of the smartest people I know in the industry. And the minute I saw Raj doing it, I'm like, I got to learn what Raj is doing.
Yeah. Awesome. Very cool.
Cool.
I have one journal question for you. I remember when you started your presentation. By the way, it was very informative and very nicely put together. Your presentation, I really enjoyed it.
Thank you,
kudos to you for that. But I have a question. It's a generic question in the beginning. You know how you had the pyramid structure and then you were talking about the different layers and how different mindsets that you're working. And then I would say 90% of the people, it's due to the society conditioning or the way we brought up. The mental status is always survival, right? People don't think beyond survival. They're just living with their limited beliefs. Yes, I have to save. If I die tomorrow, who cares? I have the savings in the bank. I don't want to live, right? So how do you deal with those kind of mentalities, you know, and how do you convince them, okay, investment is a better way, it's more protected, and then you're gonna be saving more, though it's not that visible to you right now, you know, just getting them out of that survival mental status.
You know, actually, it's funny you mentioned that because I actually have the reverse problem. The people who want to save and who are only used to savings account are more open to this because it's like, hey, it pays way better than savings account. And you said the word safe. I'm very happy, you know, but the people I have more trouble with is the investors in the markets, the stock market, who are going like, I don't want to make 5.5%. It sucks. I'm like, Yeah, it sucks, but you're not making 10% in the market as much as you love to believe it, and it's not tax free. So show me what your after tax wealth in your tax account is, in your stock account is, and show me that you've made that every year for the last 20 years or 30 years. And then we'll talk. That's really more of the conversation I have, because a lot of my investors are tech professionals, a lot of my clients rather, and they always challenge me on, oh, I make so much in my market. I'm like, yeah, go invest in your market. Let's see if it consistently holds up. And yes, you're doing this yo-yo, and over time you might be fine, but you're not compounding still. You're not compounding because every time you have that negative compounding effect when you lose money in the market. So you're starting over in a lot of ways. I mean, I did that with my 401k back in 2008, like started from half and then again went up. So that's a easy argument. If you like safety, this is the thing for you.
Mhm.
So I think we did a good job, make some impact, right? Let's go make some impact.
Yeah.
I guess Eric asked, are there shorter term policies? How should
Um,
it refer to?
So the policies can be funded any which way you want. So I can say, hey, I want to fund my policy only for 10 years. And after that, I don't want to fund it anymore. You want to pay for 15 years, you don't have to fund it anymore. You don't have to take a lifetime to fund a policy. It just depends on how much dollars you have and how many years you want to pay those dollars. So some people might say, hey, I want to put in little, but I want to put in a long period of time. Some people might say, I want to overfund the heck out of this. The first 6 years, and then I just want to sit back and enjoy it. So it all depends on you and how we can structure it any which way you want. And if you set up a consult with me, I'll actually go through, I usually look at a holistic picture. So I'm looking at the financial questionnaire. I have them fill out all their sources of money and investments. And then I go, okay, what's reasonable for this person to put in every single year for, let's say, the next 10 years? Or if they are 50 years old, maybe they don't want to do it for 10 years. Maybe it's 5 years. So it just depends on your age and where you are. If you're 30, you might have a lot longer to put in and you might put in less.
Outstanding. Did that answer your question, Eric? Good deal. All right, all right. I see Mr. George, you up. I see you looking good, looking good. Outstanding. Sure.